Here's Rich Peterson, S&P Global Senior Director, to tell us, hey, Rich, what's going to happen to start the new year? Because to look back at 2016,
Sure.
Worst start to the year ever for stocks in the first trading days. And look, we had a double-digit gain on the Dow, 20% gain on small-cap stocks and the transports last year.
Well, as that great seer Yogi Berra said, it's very difficult to make predictions, especially about the future. The fact is, back in last year in February, bottomed out around 1812, and we had a great rally at year-end. In fact, from the election to year-end, the S&P gained over 6%. It was the biggest post-World War II post-election rally ever. So we had a great follow-through at the year-end with the expectation that regulation reform will happen, tax reform will happen, that unemployment numbers will be better going forward in 2017. So we'll see how it happens with the new administration.
What are the valuations look like on the market right now? Do they look rich, but have you seen the earnings expectations going up, which would make stocks look a little bit cheaper?
Well, the current expectations for 2017 are about $132 per share on the S&P 500. So based on the year-end close, we're trading about 17 times forward earnings. We're at elevated levels, and we're obviously not cheap as we were in March of 2009, but we're not as rich as we were back in 2000, 2001 at the tech bubble. So I think, you look at sectors, where's value? Maybe in energy, maybe in utilities, maybe perhaps in consumer staples.
Rich, how much are the markets counting on a sharp cut in the corporate tax? Trump's talking about 15, even to get 20. If that doesn't happen, how much of the profits rise is counting on?
That's a good question. I don't think many of the consensus numbers have baked those numbers in. The fact is we don't know whether when they'll take effect, whether it be retroactive. Probably individuals will hope it be retroactive to January 1st.
They better be retroactive.
So the jury's still out. The fact is, we're going to start seeing fourth quarter 2016 numbers reporting later this month. Expectations now for 3.2% for the S&P 500. Sounds kind of anemic, but that's going to be really the first year-over-year, second consecutive year-over-year gains for earnings since 2 years, since 2015.
Rich, Dagan was talking about how we had such volatility in our markets early last year, and that was largely, I think, due to what we were seeing, the volatility in China. Are there any big geopolitical risks that you're looking for in the first half of this year? Any hot spots globally that you think could potentially affect our markets?
Especially Italy.
Well,
right.
Obviously, as Steve mentioned, the financials in Italy, the banks are precarious. That transfers. Also, on a geopolitical world, whether, as I said, whether Russia takes any action in the Baltics, that could be alarming the markets.
Building on what Steve said, clearly the market's been up since Trump has won. It's been called the Trump bump. There's an expectation that you're going to have pro-growth policies. Deregulation is going to be a big theme and certainly a priority of this administration. Consumer confidence is up. How real is all this? How long can it be sustained? And what about Fed policy now, which looks like it's going to begin to raise interest rates again? How do all of these things impact this year?
Well, there's talk that maybe the Trump administration will foster a increase in CapEx, capital expenditures, but the jury's still out. The fact is, for the energy sector, most importantly, CapEx spending was down 40% in 2016 from 2015. In fact, if you look at the numbers last year, they were at the lowest point since 2007. Now you have the rig count on the ascent. You have some numbers that show some increases. But I think, looking for 2017, you look at CapEx at the whole, looking at low single-digit numbers, because you really need to pick up an international demand to have for companies to spend more. And plus the fact that many companies are highly levered now. If you look at the cash to debt ratio for the non-financial S&P 500 companies, back in 2007 it was about 36%. Now it's about over 48% as companies took on debt to do buybacks and M&A.
Right, and you saw buybacks pick up toward the end of the year even. You saw some announced of increased buybacks. Rich, it was good to see you. Happy New Year.
Happy New Year to you and all.
Come back
Fox Business
often
viewers.
in 2017.
Thank you.
Rich Peterson from S&P.